Good afternoon and happy Thursday, everyone. It is Scott Wohlers with River Place Capital. It is Thursday, April the 14th, and just wanted to take a brief couple minutes and talk about what we saw in markets last week, kind of what is driving all the daily volatility that we're really seeing in the marketplace, and then talk about where markets are moving from here. So last week was a down week, and we were talking last week about the possibility of economic slowdown. We saw the 2 and 10-year yield invert. We explained the 3-month and 10-year is a more accurate representation of an economic slowdown. And since then, we've really seen a big spread in the 2 and 10-year Treasury yields, and the 10-year is well ahead of the 2-year by about 30 basis points now. So a big cushion there that we've seen in the yield curve, which is a very encouraging sign. And last week, the S&P 500 finished the week down 1.2%. The mid-cap index was down 3.3%, and the small cap index, as measured by the S&P 600, was down 4.2%. So a down week across the board, especially in the smaller indices. We saw a lot of selling pressure there on the fears of economic slowdown. Well, as we enter in this week, we get the inflationary numbers, and we get 8.5% consumer inflation, 11.2% producer inflation. The consumer inflation is the highest number we've seen since 1981. And on the producer side, or the business side, it's the highest on record of inflation. So what does that tell us? Well, a couple of things is we may very well be right near peak inflation, because costs can't consistently just go on an upward trajectory. One of the encouraging things that we got this morning from an economic data perspective is consumer spending was up 0.5% month over month. Even with these high inflationary numbers, it's still showing that the consumer is very strong. But we've entered into the second quarter, and we are entering in what is known as the quiet period. And what the quiet period is companies and corporations, before they report earnings, have to be quiet for the 2 weeks prior to them reporting earnings. And over the course of the next 2 weeks, 2 to 3 weeks, you are going to get a lot of corporate earnings. You've already started to see some of them come in with the big banks. They're a little bit of a mixed bag. Some of them are better than others and have better outlooks than others. And what investors are sitting back and waiting on is they're waiting to see not necessarily what the quarterly numbers are for these corporations, but they're waiting to see what their outlook is for the remainder of the year. Do they see a slowdown coming, or do they still see business as very strong? So investors are kind of sitting on the sidelines during this quiet period, as they do typically every quarter. For the most part, you will see during these quiet periods, in the very beginning of each quarter, the first 2 weeks, you will see typically a lot of increased day-to-day volatility in the stock market. And why is that? Well, there are tactical investors, there are algorithmic investors, and there are quantitative or quant investing. And they're all kind of run by computers. And so what you are seeing happening during this time, the other important thing to note is that when a company is in its quiet period, it also has to suspend its buyback. So it can no longer buy back its own stock, offering another level of support in the market. So during the quiet period, you really will see these algorithms really run rampant and cause day-to-day volatility in the equity markets to increase tremendously. So for example, you can see it on a day-to-day basis almost. If you see the 10-year Treasury yield moving higher, you will see the NASDAQ being sold down, which is growth stocks. You'll see the Dow outperform, whether it's on a negative basis or even be positive, while the NASDAQ is being sold off into negative territory. And as we're speaking right now, the Dow is hovering around the flat line and the NASDAQ's down 1.5%. And it's all due to the yield moving higher on the 10-year. Margin compression, we've talked about this all year, about the margin compression for growth companies. So what's happening is you're seeing this volatility. You have a lot of institutional investors waiting to hear from corporations. You have retail investors doing the same thing. And all while these machines are running rampant throughout the day, moving equity markets up and down. And if you see the 10-year yield drop down, then you will see the Dow underperform the NASDAQ, and the NASDAQ outperforms and growth outperforms value. And you normally would see these, but we're seeing these now on an intraday and a day-to-day perspective in this quiet period. So that's really what's causing the volatility here on a short-term basis. But we really believe that the overall basis of the United States economy continues to remain very strong. The consumer still remains very strong with a very strong balance sheet and is not over leveraged. So it gives us a lot of encouragement that we can offer and land a soft landing with the Federal Reserve raising rates and tamping demand a little bit. But with that being said, we still think we're going to march a little bit higher towards the end of the year. And as always, if you have questions about what to do during the quiet period or what that is and how that impacts you, feel free to give us a call. We're easy to talk to. You can reach us at 904-346-3460. Thanks so much and have a wonderful rest of your day.